Hello, fellow traders. 'Tis I, the Rumpled One, coming to you Tuesday, September the 17th. The year's 2019. Let's talk trading. Advanced Wick Zones, Part 2. Yesterday, I was showing how range works with the Wick Zone. And so if you know the range and you see price in the Wick Zone, you can understand the reason why taking a Wick Zone trade could be profitable. But remember, fellow traders, these videos are for educational purposes only, and your results may differ from mine. And that Forex trading, as all trading, is very, very risky. You can lose all your money. So if you are seeking advice, seek it from a financial or an accredited financial professional rather than some Yahoo on the YouTube or on the internet, on some trading forum. Because that way, if you lose your money, you know it was lost by a professional. But no matter where you get your advice, you have to use your own risk management. You have to set how much you're willing to lose on any given trade, because it's a possibility that you might lose on a trade. In fact, I was in a chat with somebody that has a Facebook group, and I posted yesterday's video, and then he removed it, and we got into this discussion. I guess I just, strike fear in the hearts of other forum leaders and website hosts and YouTube channel people, because if I happen to make a comment or post something, many of them seem to get upset. But because I guess I just speak in such simple terms that are easy to grasp, easy to understand, and kind of just blow away all the myths that others like to perpetuate when it comes to trading. So, as you can see, we've got a few gaps still that haven't filled, but if you participated in that Sunday gap on some of these pairs, there was a lot of profit to be made. A lot of profit. And since we're talking about range and what it has to do with the Wick Zone, let's just take a quick look here at the range. So far today, 1, 2, 3, 4, 5, 6, 7, 8, 9 pairs over 100 pips of range. As you can see, the dollar yen is lagging at 34. But even with the dollar yen, you could see here on this daily range, price entered the upper Wick Zone, exited the upper Wick Zone to the upside, the long side, and you can see here there's a difference of 20 pips between today's high and yesterday's high. That was all potential profit for you if you're taking that trade. And then you see on the other side, it entered the previous day's Wick Zone and dropped 8 pips. So there's another 7 or 8 pips potential profit that you could have had. Well, let me shift over here to a another chart here, and this is using the TRO 2017 dashboard. And since there's a couple people out there that were asking about ATR and on the dashboard, let me just show you how I set this up. So first we have price there, and then we have range, and this is the daily range. Then we have ATR, and this is the daily ATR. Okay, now you can see here, just so you know, this is column 10. So starting here, this is column 1, and it goes this way. I believe you can have up to about 19 columns that will fit across the screen. And so what I did was I said this is column 10, and I put this in column 5. And the thing about the numbers is if you repeat numbers, the indicator's smart enough to just kind of paint them as it reads what's going on inside your inputs there. So we have daily range, weekly range, monthly range. So right now we're looking at a daily chart right here, and that's the bid, that's the ask. If you're wondering what these are, from the spreads dot indicator. And you can see here we have a weekly range so far 91 and a monthly range so far 262. So if you're looking here at the ATR, average true range, you can see whether or not these ranges have exceeded their averages. Okay? And if they haven't, if they're nowhere close, then you know there's possible movement for the rest of the day or rest of the week or rest of the month. And once again, looking here at the daily and weekly range gauge, you can see 34 today, 91 for the week, and you can see where price is within these ranges. So the brown is today's range, or ATR, the open plus the ATR. So you get your upper ATR range if price moves. And you can see how prices once again hit the about half the ATR to the upside here. So we had our daily open, it moved up to the ATR, pulled back, moved up again, and pulled back, showing how about the open plus half the ATR is a good place to either take profit or possibly enter a reversal trade. Now we're talking about wick zones and ATR. So here's the dashboard showing the wick zones. And this is just so you know what indicators I'm using here. This is the TR 2017 Wick Zones indicator. Because back when I did this in 2014, I was focused mainly on the daily. But then as I was running statistics, I also saw that there was a lot of possibilities on the weekly and the monthly. So right now we're looking at the H1, but if we just switch over to the daily right here, you can see, once again, we're outside the wick zone, so no wick zone trade. If we switch to the weekly, once again, we're outside, no wick zone trade. And if we look to the monthly, you can see we're not near a wick zone. But here on the monthly, we actually opened in the lower wick zone, went down, and when we exited that previous month's wick zone, you can see that there was a lot of pips to be made. So yeah, you can even trade off of a monthly chart. But let's just look at another pair here to see if we see something in some wick zones. The CAD Swiss franc, just so you can see here. We're in the upper wick zone on the weekly, and you can see here, this is the upper wick zone high, and the weekly and this is the weekly top here, that wick zone. Whoops, how did that happen? So this is the top of the month of the weekly candle. It's the top of the weekly candle. Here's the top of the monthly candle, and there's the top of the monthly high, previous month's high right there. So this isn't all green because this is canceling out. You can see how these zones are overlapping. And let's just look at, okay, this might be interesting. We've got it in an upper and a lower wick zone here. So you can see it's in a daily upper, but it's in a weekly lower. And so this means it's crossed above the high right here. This is crossing below the top, and this is crossing above the bottom of the candle, and this is crossing below the low of the candle. That's how you read those. But the main thing is that if price gets inside of a wick zone and it hasn't hit its range of the day, chances are it's going to have to range outside of that wick zone. And we show here using the TRO HL5 indicator that I'm still going to have to upload this latest version so you can see all of the different or have the shading for the other areas. So here you see the monthly upper, monthly lower, and we have the weekly upper, weekly lower. And if we switch over to, let's say, H1, then we can see the daily upper and the daily lower. Now let's put things back. And I didn't want the Canadian. And this is interesting. Somehow the dashboard got moved. We'll have to move it up. So I can uncover that button. So looks like I'm going to have to do some work on this template. But there's back to the end. And you can see here on the Einstein lines, since I've been shifting around, we missed out, but before I switched pairs, the Einstein line was cutting across about here, and there were some of these great spikes that you would have seen. And once again, since I just switched pairs, the tick chart's been obliterated. And here we have the dollar yen showing coming out of that upper wick zone. And there's the lower wick zone. It hasn't entered it. And you can see here, since it started here, this was the open, which was pretty much the previous day's close. Now, price has to range from that. And you can see it ranged outside in both directions. That's how you use range. You can see we've only got about 7 pips of an upper wick zone, and the average range was around 50 something for the yen. So it should be obvious that price is going to have to exit this zone. And ditto when you look at weekly and monthly. And so once again, just coming back here, you can see price is now exiting the upper wick zone of the previous day's candle. So I hope that explains how you can use range in combination with the wick zones and feel that, hey, I've got my stop loss in. We have a pretty good chance of making a profit here because price doesn't like to stay in the wick zone. It usually exits the wick zone in the 70 percentile range. So it's a relatively profitable trade and a relatively safe trade so long as you employ your stop losses. So if you're going short, you put your stop loss maybe 1 pip above the previous day's high here, and you take your chances. Sometimes you'll win, sometimes you'll lose. But as I was discussing with a guy, I say never lose again. Of course you're going to have a losing trade, but it's kind of like having a winning season. You're not going to have a losing season. So you might lose on a trade, but you're not going to lose on a session, or you're not going to lose on a week or a month. That's the whole idea, is to make that forward progress. So remember, fellow traders, it's not what you trade, it's how you trade it. So go out there and drain the banks. Hey, and if you haven't, come down here and hit the subscribe button.